We're going to get started. Our panel is entitled Policy Responses, which I think means that we are to enlighten the audience as to how to solve all of the problems that have been discussed earlier today. And for those of you who know the players, you will expect unanimity among the panel. I will say Paul began the day by pointing out that I don't understand boxes, and I should correct him. I don't understand formulas either, but words actually you can probably get some benefit from, and that's what we're going to engage in up here. I'm tempted to introduce the group by describing the red corner and the blue corner, but I won't do that. I'll just introduce them from my left in the order they're going to speak. Most of these people are well known to you, and I won't say much about them. Michael Devereaux runs the Center for Business Taxation and teaches economics at the Syed Business School at Oxford, so you should not believe what his resume says in the book. It's at least 10 years out of date, I think. Stephen Shea teaches at Harvard Law School. He was Deputy Assistant Secretary International at the Treasury Department and practiced law in Boston for many years. Jim Hines is a University of Michigan economics and law professor, trained in economics and teaching law, which tells you a lot about law schools these days. But Jim is the director of the ITPF Research Institute, and I think along with Mahir Desai wrote the first analysis of corporate inversions, at least the first one that I remember reading. And Ed Kleinbard is now a professor at the University of Southern California. He was a practitioner in New York for many years and chief of staff of the Joint Committee on Taxation. So we have a experienced and knowledgeable group, and I am the referee. Michael, you're up.
Okay, thank you. Thanks for inviting me. I got 5 minutes, I believe. So what I thought I'd do is address some broad questions. My fellow panelists know far more about the US tax code than I do, so I'm going to leave them to trade section numbers with each other and deal with the big questions, I think. So I just wanted to make a few kind of very broad points to start off with. First of all, when we talk about policy and policy recommendations, we often get disagreements between people, and often the disagreements stem from unacknowledged and implicit assumptions about what we take as given in the tax system. There may be, when we're thinking about inversion rules, for example, are we taking as given the rest of the US tax system or not? How broad are we talking about? And I think quite a lot of disagreement stems from actually people starting from different points. So I hope we can be clear with each other exactly and with the audience exactly where we're starting from here to try and make explicit what we take as given and what we don't. Second point, there are lots of problems. Taxes cause lots of problems, and governments address those problems in a number of ways, but quite often they address them in ways that don't address they don't address the underlying problem itself, but they deal with the symptoms. And I think there are many examples of that. There are many examples of that in international tax, for example. So I think if we just think about international tax broadly, then what does the international tax do? We go back to the 1920s compromise, as Michael's referred to it. So active business income is taxed in the source country, passive income, dividends, royalties, and interest taxed in the residence country. That might seem like a good idea in the 1920s, but it causes innumerable problems because we have to figure out what residence means, we have to figure out what source means, we have to figure out what royalties, what are interest and dividends. And many of the problems of trying to allocate profits between different jurisdictions come down to those kind of problems. We've already talked, for example, about how we measure residence this morning. Is it in place of incorporation? Is it place of effective management and control, and those kind of issues? So actually, as an aside, aside in 5 minutes, so I'll be quick. But the OECD BEPS project, for example, is taking the existing system as given. It kind of started off by saying we're going to have a fundamental review, but actually what it's doing is taking those principles as given and trying to fix some of the problems that it observes there. And it's trying to fix it in ways which actually may well be introducing more problems down the road. So one of the things that the OECD BEPS project seems to be doing is to say, we ought to be looking for economic substance. Now that's, that may or may not be a good idea, but it's not actually part of what the original system was trying to do. So it would be much better, in my view, to actually go back to fundamental principles first and say, well, what is it that we're trying to tax? And then figure out how the tax system should address that. Okay, coming to inversions. Why is it that US companies want to invert? Well, we've heard about that this morning. One is that foreign companies find it easier to strip income out of the UK than US companies because of US CFC rules. And the second is that the worldwide tax system in the US doesn't allow multinationals to bring income home without a tax charge, so they leave it outside the US. So those are two real problems. How should we address them if we think those are the problems? The first question is, well, are we happy that foreign companies or foreign owners of US subsidiaries can easily strip income out of the US through use of debt? And if we are, then okay, there's no problem. If we are worried about that, then we should do something about that. We should have rules which address that particular problem. What the anti-inversion rules say, well, we observe foreign owners of US companies stripping income out of the US, so we better stop US companies becoming foreign, because otherwise they'll be allowed to do it as well. That seems like a kind of somewhat indirect route of trying to fix this particular problem. On the second problem, it's what I think Ed called the AirSats territorial system. It's not a worldwide system at all, because the US actually doesn't raise very much tax revenue from taxing worldwide income, but the main effect is to keep all this money offshore. So do we think that's a problem? I think we probably do. That's bad for US multinationals, but it's bad for the US as well, because that money is not coming back and being reinvested in the US. So that seems to me that this is a broad question about the US tax system. How should we try and address those kind of questions? Anti-inversion rules, are they addressing those problems? They don't seem to me to be addressing those problems. What they're doing is designed to kind of prop up the existing system with all these problems inherent in it. And it's a tax on old capital. If you're already a US company with all the, and you've already got foreign activities, then the US anti-inversion rules are trying to stop you from going somewhere else. If you're starting up a new company, I guess if you get well advised, then you wouldn't set it up as a US company in the first place. You would just kind of set it up as a foreign company and then have a subsidiary in the US doing that. So this is also trying to effectively a tax on old capital rather than new capital. Stop there.
Thank you. You kept to your 5 minutes. Steve, you're next.
I was told to do.
Well, I'm.
That proves that you're from the UK.
And now we have an American.
Now we have Steve's 5 minutes.
No tax code sections if I can get away with it. And I'm going to follow Mike's advice, actually. I'm going to end up making 3 points about corporate inversions and tax policy. But before doing that, I'm going to start with what you might think of as my assumptions or level setting. First, the United States, along with most of the rest of the world, will continue to have a separate corporate income tax as an integral part of its overall income tax system. One theme you're going to hear me come to is just how holistic an income tax has to be to work. Second, the United States will continue to rely on the corporate tax for a small but material portion or fraction of its income tax revenue. 3, a critical role of the corporate tax is to maintain the integrity of the overall income tax, both business and individual, by preventing avoidance of individual income tax through the use of corporate entities. While the economists continue to debate the incidence of the corporate tax, no one questions that a material portion is borne by shareholders. And while there's debate about the exact extent, the data are reasonably clear that American companies, unlike what we're hearing about from Mike in the UK, are very largely owned by Americans, US residents, taxpayers. For this reason, the taxation of international income of U.S. multinationals is integrally related to the individual income tax. Next point, level setting. I spent decades advising clients how to minimize taxes, and that experience taught me that a tax system that purports to put income into neat separate categories is easily exploited, something actually Ed could speak to even more fully, I think. Wherever there is a boundary, it will be tested. Anyone who advises clients knows that the line between personal and business is porous. The just released National Taxpayer Advocate report, I think, again lists trade or business expenses as one of the most litigated issues. The line between compensation and return to capital is abused by carried interest. I could go on, but my point is it's foolhardy to put weight on the distinction between corporate tax and business taxation generally, and equally mistaken to treat business taxation as fundamentally distinct from income taxation. The same principle that a tax system is holistic in nature motivates my view that treating foreign income as somehow distinct from domestic income is a fundamental mistake that should not be exacerbated in any tax reform. So I'm going to make my 3 points now. First, I would be remiss not to start out by showing that where I agree with John Samuels. The pressure for inversions is not going to go away as a result of shifting to a territorial or dividend exemption system under any version that has been proposed by the United States to date, or that I think plausibly could be adopted. The experience of the United Kingdom, I think, has shown that robust control of foreign company rules triggered corporate expatriations. And the reason I say that is because prior to that time, they were able to use their foreign earnings with the upstream loans that Michael referred to. So their driver wasn't what seems to be the driver here, which is so-called trapped offshore earnings. Their driver, in terms of expatriations, had much more to do with CFC rules, and all of the proposals in the US are increasing the strength of one form of CFC rule or another. So that's my point of agreement. My second, and I think possibly most important point, is that the taxation of multinational business income raises important issues of economic justice. Word has not been used today. But that concept, I think, was put squarely on the table by the President's State of the Union speech. And I don't think there has been a reset in the thinking. The framework for business tax reform was put out in early 2013. It seems clear to me that after that speech, a lot of things have changed, and I haven't seen it filter back into the rest of the administration's proposals. Economic justice requires that the owners of capital pay their share of the overall tax that allocates the burden on an ability to pay basis. As I had my two co-authors, Cliff Fleming and Bob Peroni, observed in a 2001 Florida Tax Review article, it is unfair to the rest of us to give an unjustified special tax break for foreign corporate income. One of the issues we're here on, is it unjustified? That's a reform issue. Or is it justified? And that's the source of the research that needs to be done that John was referring to. But that is most troubling, that it seems to me economic is most troubling, justice is most clearly on the table when we take income that was earned under the privilege of deferral, that income was earned under the privilege of deferral. And if we allow that income to be taxed at a lower rate or to be exempted, that seems to me to raise fundamental economic justice issues if you're going to have to increase tax somewhere else. So where does all that point me? Where does that take me? And this is my third set of points. As we learned from an earlier panel, inversions seek to exploit the line determining when a corporation is a US corporation or when it's a foreign corporation. It's an attempt to gain the advantage of being a foreign corporation. And there are three tax objectives: reduce the US tax through the US tax base through use of earnings stripping interest, royalties, and other deductible payments, to avoid US tax on past foreign earnings, and to avoid US tax on future foreign earnings. So I would favor an approach that addresses all three problems. Andrew's presentation, it seems to me, showed that foreign acquirers are advantaged. And at least the data, as I understand it, suggests that those advantages are there for foreign-owned U.S. affiliates. That should be reduced by enhancing earnings stripping, and in my view, is already sufficiently an issue and problem that I do think the Treasury should move forward on the second step that was foreshadowed in its September notice and adopt some more stringent earnings stripping rules until fundamental reform is revisited. Second, we should prevent avoidance of U.S. tax on foreign earnings that accrued under rules that clearly provided for deferral. And my view is, with respect to those earnings, the time to pick up the U.S. tax that's been deferred should be when there's decontrol. Now, we can discuss whether there should be a lower rate. There are arguments for and against that, and I would say I start out with some trouble on that side, but I think that certainly everything should be up for discussion, and that's included. Third, I would adopt reforms in two areas that have not really been discussed seriously, although one of them has been talked about this morning. First, we should change the definition of when a corporation is a U.S. corporation to take account of U.S. shareholder composition. And that is something my co-authors and I discuss in an article in the Michigan Journal of International Law that's just been posted in SSRN. It's really a side discussion in that article, which is labeled formulary apportionment. But we need to start thinking about that because we've learned that place of effective management doesn't work. And yet we have a strong intuition from 78 code section, from our current anti-inversion rules, that we care about where the shareholders are, as we should if a corporation is owned largely by U.S. residents. The second major area we need to revisit that has not been talked about is the taxation of U.S. portfolio shareholders in foreign corporations, to take into account the fact that there is often a reduced corporate level tax on those holdings that does not apply, is not the case when they hold U.S. equities. So we need to fundamentally revisit the portfolio taxation of U.S. shareholders of foreign equities in relation to U.S. equities. If a corporation is going to invert and simply become foreign parent instead of U.S. parent, why should a U.S. shareholder get advantages with respect to holding a new foreign parent when the corporate tax, the U.S. corporate tax, isn't being paid on a large swath of its earnings? Whereas in a U.S. parent, it will be taxed, so under whatever system we decide to adopt. Stopping there. That's a shave 5 minutes.
I noticed. And I saw John Samuels nodding in agreement with you at I think every single word you uttered. That at least he was nodding. Jim Hines is next.
Well, I'm going to have to disagree with John Samuels then. I urge us to think about inversions from a worldwide perspective. Most of the advanced world has territorial tax systems. The United States does not. Interestingly, many American policymakers agree in one form or another that we need to move our system to make it more similar to the rest of the world. Obviously, there are many different ways of trying to do that. You know, people talk about tough territorial versus other territorial and that kind of thing, but I think there's general agreement that your tax system winds up in trouble when it differs so much from the tax systems of countries like Canada, Japan, UK, Germany, and so forth. If we think that a movement in the direction of a territorial system is good, then we could pose the question, why are so many people concerned about corporate inversions? What happens in a corporate inversion is, in essence, one company at a time. They take themselves out of a worldwide tax system and into a territorial system. And if that's what we want for the whole, suppose that's what you want for the whole economy, then why are you upset when it happens one company at a time? Indeed, the companies that inverted not only put themselves into territorial tax systems, but paid for the privilege. Because when you invert, you have to recognize the capital gains of the shareholders. Whereas some of the proposed reforms to give the U.S. a territorial system wouldn't impose that large a tax on the transaction. I mean, again, the proposals, of course, differ in their details. There is a reason to be concerned about one-at-a-time tax reform of that type. And it is that, it's less efficient than sort of having a broad playing field for the whole economy of firms. And it sort of makes more sense if your companies are going to invert one at a time, you may as well just adopt a territorial system in the first place. And of course, there are many proposals to do that. As the session with Andrew Bird and Mihir Desai noted too, one of the things you worry about is that because of the current difficult, the costs imposed on firms that invert, obviously it's only a portion of companies that do that, a rather small portion. And so it creates incentives for foreign takeovers for those who don't invert. And if you have excessive incentive for foreign takeovers relative to domestic ownership of these companies, that could cause problems because then you have inefficient ownership of business assets and you've got other issues associated with having foreign owners relative to domestic owners. So how should we think about inversions generally? Here's the reality. It's still only a portion of the corporate sector and a relatively small portion. The issue with corporate inversions is what is it telling you about our tax system? And it is also partly what is happening to the resources of these inverted companies. One way to think about what do inversions do? They take assets that would have been owned by a US entity and make them owned by a foreign entity, in this case by changing, obviously, the residence of the ownership entity. If that's our notion of what an inversion is, inversions are happening every day. In some days, every hour. When are they happening? They're happening in the world around us. Probably next week, there will be a company that is acquired in Singapore. And the acquirer might be a German firm or it might be an American firm. Singapore is a low-tax country. Germany has a territorial tax system. It's generally more beneficial for from a tax standpoint for a German owner to own a Singapore company than it is for an American owner to own a Singapore company, because with the low Singapore tax rate, there's a residual US tax due ultimately on the Singapore income, whereas for the German owner, there is not a residual tax due. And so in the bidding for that Singapore company, the German firm has a tax incentive to bid a bit more than an American firm does. And over time, there are going to be more German acquirers of those Singapore firms than there will be American acquirers. And those Singapore assets will not be owned by an American company. They'll be owned by somebody else. We don't call that an inversion, but that's our use of language. What has happened there is that the US tax system, by taxing foreign income the way that we do, has caused an asset that would otherwise, in this example, have been owned and controlled by the United States to be owned and controlled by a firm from a different country. That's what happens in an inversion, but that's what happens every day in the business world because of the US tax system. So if we're concerned about inversions, we should be concerned about what happens every day, which is that we've got this erosion of ownership of assets by American companies due to the actions of the US tax system compared to the actions of the tax systems of all the other OECD countries that look very different than the United States. In addition, it goes on. The companies from countries other than the United States, those who have territorial tax systems, generally speaking, have less fettered operations, domestic and foreign. With American firms, as we know famously, it's hard to transfer resources back and forth because you can trigger taxes. It impedes the US tax system, the CFC rules, impede other aspects of American firm operations that would not bear on firms from countries that have other rules. So what should we want at the end of all of this? Look, it's complicated. People get emotional about these issues, and we're all concerned about tax revenue, and for good reason, because the country needs tax revenue. But the country needs tax revenue and it needs economic prosperity. And actually, these two go hand in glove together. The more prosperity you have, the easier it is to raise tax revenue. Duh. So what should we do? What we should want is the most efficient business setup possible. If you have the most efficient and productive businesses, then you will have higher worker productivity and higher wages, and you will have greater tax capacity. It's not really very complicated. So our discussion really should be about what is the most efficient configuration. Specifically when it comes to inversions, then, is it more efficient to put on rules like 7874, there, I said the section number, and the regulations that were of which we recently got notice, and other rules to try to prevent corporate inversions. Is that the efficient thing? Or is the efficient thing to learn from the corporate inversion experience that we don't have a very efficient tax system relative to the rest of the world, that we are distorting the asset ownership of American companies, and encouraging foreign takeovers and encouraging foreign expansions at the expense of US firms, and use that as impetus to try to get a smarter tax system and a more efficient tax system? Obviously, I'm in favor of having a tax reform that would create a more efficient system and thereby enhance US productivity. Steve Shea, just before me, raised the issue of economic justice. And of course, that always has to be part of our tax discussions. How should we think about economic justice in this context? I urge you again to take a worldwide perspective on that. Is it just to have an American tax system that looks so different than the tax systems of other countries that are otherwise similar to the United States, like Canada, like Britain, like Japan, like Germany, in order to have the system appear to be consistent with our taxation of individuals? If we want to help American individuals, the way to help American individuals is to have an economy that makes them productive. There are a lot of ways to do that, but you cannot be productive unless you work for firms that themselves are productive. And our tax system is impeding the productivity of American firms and thereby hurting American workers. You'll help American workers if you make them more productive, and the way to make them more productive is to remove some of the tax impediments to efficient business operations.
Thank you, Jim. I was waiting for him to take a breath.
No.
In order to thank him, but it took a little time. Ed.
Thank you. So I had a little bike crash and a small concussion, and as a result, I was warned by my internist that a concussion can have emotional ripple effects for several weeks. And it was true, and I found myself to be uncharacteristically nice for some time. But the effect was slowly dissipating, and having listened to my friend Jim, I can now say I'm completely cured. Look, let's begin with clearing the air on this fundamental misimpression. We don't have a worldwide tax system in the United States. We have, in fact, an ersatz territorial tax system. U.S. firms operate in practice in a territorial system without any of the safeguards that would be imposed by a well-ordered territorial system. There is a cost for that ersatz territorial system, which is lockout. And that is a stupid kind of place to be. No one can disagree with that. What we want to end up with from an international point of view is either a territorial system that works or worldwide tax consolidation, because both of those solve lockout. There's no lockout effect in either case, once you go to either extreme. And it's important to therefore keep in mind that we have a solution other than territorial, which needs to be fairly considered. There is at the same time a fundamental problem that we have in the United States and that the rest of the developed world has, which is the problem of stateless income. Now, the U.S. firms have been the world leaders in tax avoidance technology, but they've taught others well. And the result is extraordinarily low effective tax rates on foreign income of U.S. firms operating outside the United States and non-U.S. firms operating outside of their home jurisdictions. In the case of the United States, just to be clear, we have about $2 trillion of offshore permanently reinvested earnings, about $1 trillion of that in cash. Just to correct what Mike Devereux said, it's in the U.S. economy because that cash is invested in U.S. dollar assets, but it's not in the right place. And I agree that those are economic inefficiencies. So what do we do about stateless income? We can see the example just the other day in Amazon with a structure that is laughable on its face as a matter of economic reality, as a result of which Amazon pays essentially no income tax anywhere in respect of its European operations. The BEPS project is responsive to that. This is not a problem where the United States is in it alone. Every developed country faces it. I agree with Mike Devereux that the BEPS project is likely to fail because it begins from the wrong premise, which is to respect the separate, the separate economic reality of each juridical entity, every little subsidiary as a risk taker with its own capital structure and so on. The fundamental premises are ones that really ought to be revisited. So if we have this problem of US firms reporting single-digit effective tax rates, we don't have a competitiveness problem. They enjoy those single-digit effective tax rates on foreign income in respect of their cash tax liabilities and in respect of their GAAP liabilities. But we do have fundamental distortions that come from essentially a unpoliced territorial tax system today, and on top of that, the bizarre distortions of lockout. So, for example, in Jim's discussion of the Singapore case, right now, US firms buy other foreign firms at a discount relative to their other opportunities because of the lockout effect. So, if anything, we're incentivizing US firms to buy the Singapore company, not the other way around. Inversions in 2014 are, of course, a canary in the coal mine. They are a sign that the system is fundamentally broken, but they don't by themselves tell us what the new system ought to be. The wave of 2014 inversions, I think, and here I confess having spoken to dozens of institutional investors, to have closely followed the filings of a number of firms. In fact, they're driven by three things. The first is the repatriation game that the September regulations put a stop to get effective repatriation largely tax-free. Second is earnings stripping. Earnings stripping is a polite term for eroding the U.S. domestic tax base in ways that are fundamentally unfair to the positions faced by wholly domestic firms that are direct competitors. I'm all for efficient tax systems. Jim and I agree on that. But I think the place where you start is at home. And right now, the question is, do we have consistently applied tax rates to different firms conducting business in the United States? So the three reasons for inversions was the repatriation. The second is the earnings stripping. And the third was financial accounting anxiety. On information and belief, financial accountants are getting a little bit fed up with the representations being made to them of firms with tens or even $100 billion in offshore earnings, that not to worry, one of these days they'll come up with a plan to really do something with all that cash. And the financial accountants themselves are putting some pressure on firms. Is all of this problematic? Of course it is. Jim and I would agree that there are distortions all over the place, and we could agree that we could do better at that. But the answer is not to endorse inversions as simply heroic first movers to a new territorial regime, but to have temporary legislation so that everybody is in the same soup rather than encouraging a pell-mell rush to the exits from which revenues inevitably would suffer. Finally, you need to take a step back and say, what is the corporate income tax? It's a tax on capital income. And how are we doing in general at taxing capital income? And the answer is, we're doing a piss-poor job. We have... Is
that a technical term?
It is. It's 78, 75. We have negative effective marginal tax rates in the United States of America today on debt-financed corporate investments in greasy machinery. That means we all in this room are paying firms to make those investments. That's insane. Negative effective marginal tax rates is probably not the right rate. We have super low effective tax rates on foreign earnings of large, successful US multinationals, whether it's Amazon, whether it's Google, whether it's Microsoft. There are a dozen other examples, whether it's the pharma industry, dozens of other examples. And again, that's crazy, because if we want a territorial system, great. But what a territorial system implies is that taxes are actually being collected in the countries where business is really being done. There's a strict connection, a geographic nexus between the income and the business activities. That is the entire intellectual predicate to territorial systems, and the only problem is it's impossible, in fact, to do. That's why we talk about a territorial system with teeth, having a minimum tax, for example, as part of the territorial system. Well, what that really is a territorial system and a residence, with a residence system bolted on at the bottom to assure some minimum level. So what I want is a territorial system where the minimum tax happens to be the same as the U.S. domestic rate, which is another way of saying genuine worldwide tax consolidation. Finally, we have, in the United States, way too high an effective marginal tax rate on equity-financed domestic investment. All of this points to lower corporate rates, and it points, I believe, as a practical matter, to worldwide tax consolidation in respect of foreign earnings, not because it's the best idea in theory, but because we face a Hobson's choice between two disagreeable alternatives. And as between the two, in effect, putting a floor on foreign tax avoidance strategies will give courage to our European brethren to stop their race to the bottom. It will collect some tax, and it will provide a happier domestic environment. To get to there, the critical piece that's going to supply the revenue that we all are going to have to suck it up and start to think about is that we're going to face domestic thin cap rules. We cannot go on any longer with zero tax on corporate income that is debt financed or negative when you take accelerated depreciation into account, and significantly high rates in respect of equity financed.
Thank you, Ed. Michael, I want to congratulate you again on the 5-minute rule.
Time goes slowly in Brookings.
Let me just make a couple of observations. I want to see if I can find a little agreement. And it seems to me that you've raised every issue, I think, of international taxation, which makes it seem to me that we all agree that inversions are a symptom and not the underlying problem. That is, that they are a symptom of other structural difficulties, that there are differences about how they might be resolved, but that they can only be resolved in some sense through fundamental changes in the U.S. tax system. And that I see everybody nodding their head about, and so I think I'm just going to take that as agreement. There are two other points that at least I want to raise. One is I sit here, and I've been sitting here all day looking at how the U.S. has evolved in its treatment of inversions. And I remember Jim's early paper about people moving paper to Bermuda and getting these tax benefits. And my thought was, we were better off when all they were moving was paper to Bermuda than we are today when they're moving people to Switzerland who don't like the Swiss Alps and are moving back, and then the Swiss people take over the company. And the more you tie economic substance to the tax rules, the more risk there is of moving real activities. And it seems to me that we need to think about that rather carefully as we build these rules. Two other points. One is that residence and source are both hard concepts to live with in the modern world, even though in the 20s and even in the 60s for the U.S., when it had all the money there was because of the war, they were reasonable, but now they've become less reasonable. And the one piece that we cannot tax, at least as I understand things, are the foreign income of foreign companies. And so this, it seems to me, is a constraint on some of the notions that are floating around here. That is, if you are going to take the position that you can't tax the foreign income of foreign companies, and you're not going to bar foreign ownership of U.S. operations. And all you can tax then is the U.S. income of foreign-owned businesses. You've got a bit of a conundrum. And it does seem to me that you then have to ask yourself two questions. One is, and this I'd like to get everybody's response to, these are genuine questions, and see if there's agreement. One is, does it matter to the U.S.? So I care about U.S. welfare. I know Jim cares about worldwide welfare, but I'm just a nativist. And I care about U.S. welfare and the well-being of the U.S. people, and if we want to give money to others, we'll do that. I don't mean that literally, but that's my starting point in thinking about U.S. tax policy, since it's the starting point of thinking about U.S. policy generally. And so the question is, does it matter to U.S. Citizens and residents whether domestic operations are U.S. owned or foreign owned? And that is, does having a U.S. owned headquarters make a difference? Or does it make it more likely that we will have a headquarters if it's U.S. owned? That's question number one. And question number two is, does U.S. ownership of foreign operations make a difference? That was the example that Jim gave, where the German and U.S. companies were buying the Singaporean company. Do we care about that? And if so, why? And so I would really just like to see first whether we agree on those two principles. If we disagree, then I do want to hear more about it, because I think they're fundamental questions in how one thinks about the basic problems that each of you in your own way has raised. If you could, for a moment, put yourself in the mindset of an American and ask yourself, would U.S. take these questions the way I put them? I gather the UK has made a decision that U.S. headquarters matter to the UK, and that UK operations may matter to the UK. But we just go down the panel and see how people react to this, because I think the answers to these questions are important in trying to sort out what it is you can do here.
Me first.
You're first.
Okay, how long do I have?
A minute and
You're
a half.
in America, as long as you want.
You have a minute and a half. That's it.
So does it matter to the US whether domestic operations are domestically owned or foreign owned? So me here kind of addressed this a bit this morning. So you'd want, I guess there are two aspects to that. And one is, you want it to be owned by the people who are going to run it the most efficiently, because that's going to be good for the state of the business. The employees, the customers, prices are going to be lower, wages are going to be higher if it's run in an efficient way. If the most efficient people to run it are British people, then that would be good for America. There may be another aspect there that, if that actually means some profits are going back to Britain rather than staying in the US. So that would be a counter argument, I think. So maybe it's, there's, to some extent it would be better for Americans to run less productive firms in the US, because at least all the money stays here and doesn't get taken away.
Well, and the management and control, as Mike pointed out earlier this morning, would be in Britain and not in the US. And there are at least some literature that suggests that having management and control domestically, headquarters domestically, has some benefits, right?
Yes, but
magnitudes. Magnitudes.
Other things being given, yeah. Does US ownership of foreign activities make a difference? Well, yes, again, if the US is kind of losing opportunities because of the tax system, if the US people want to go and invest in Singapore and they're not able to do that because German firms are buying out all the Singaporean companies, then there's a lost opportunity to the US, yeah.
So does everybody agree with Michael on these issues, or does anybody want to say anything more? Okay.
I agree.
No. No, I think the question...
Oh, you don't agree, or?
The part I agree with is that people the best effect is have people run an operation who will run it most efficiently. I think the core problem with the question, Michael, is it starts, when you ask U.S. owned versus foreign owned, you're starting with, I think implicitly you meant U.S. corporation owned versus foreign corporation owned. You weren't disregarding the corporation. And I think what we have to start recognizing is, among the other things that have changed since 30s, 60s, whatever, between the corporate form is losing its viability. We ignore it with check the box. Inversions have demonstrated it doesn't matter whether the box has a label US or foreign. Both the early naked inversions or self-inversions and the inversions that we've seen more recently, nothing changes in inversion. I've worked on an inversion, it's been completed, it's in the public domain, and the biggest question was, where is the box going to be? Is it going to be the Netherlands, the UK, or Ireland? That was one set of questions, and the investment bankers come up with their enormous array of pros and cons, governance and otherwise. And then the second biggest question was, do we have to fly there? Paul can tell me whether I'm wrong. Or his experience is much broader experience, but basically management wants to know how often they're going to have to leave their headquarters.
So the fundamental, I just want to understand what I think to be the fundamental point you're making, which is that in the current world, we ought to be looking to the owners of the capital and taxing the shareholders, and whether their income is coming from a foreign corporation or from a domestic corporation, and that in some sense we're starting from the wrong place. And the Treasury Department in 1992, when it proposed a dividend exclusion system, which was then enacted in 2003, got it exactly backwards. And that is my view today, although I was an active participant in the 1992 Treasury Department study. I like to say if it was right then, it's wrong now, but the truth is probably it was always wrong. And that what we ought to be thinking about is how we're going to collect tax on the owners, because they're much less mobile and so forth. And there are a number of proposals out there for doing that, ranging from various forms of integration and so forth. That point, which I think goes to your justice point and to your economic efficiency point, is fundamental and so far has not gotten into the tax reform discussions.
Well, except for the Senate. I see Chris Hanna in the back.
Well, the Senate report, that's correct. The Senate staff report has talked about it a good bit. So it may get into the domain. They may be putting it in the domain.
And also, I think you don't have to go to integration. That's why you have less pressure on existing forms and approaches if you think about corporate residence taking into account shareholder composition. So just to tie it back to what I was raising before.
So my superiors have indicated that we should open this up to the audience for questions, which I'm happy to do. Yes, over in the corner.
I get the benefit of being close to you.
The tall fellow near the microphone.
So 2 questions. First for Ed, I guess I'd like to square your depiction of the wonderful tax status of U.S. multinational firms with inversions. How do you square that Pfizer approaches AstraZeneca and they say, I want to be a UK firm? They never say, we should be a US firm. So I just want to understand that. And then Steve, I guess I appreciate the appeal to justice. It's moving in many ways. What I don't understand is how, in what world does international tax policy become the preferred instrument for income redistribution? I just don't get it. So I'm all for justice. I think you meant justice not in the way that Ed meant it, which is across firms, but you meant it, I think, in the context of income inequality. So then I have to get convinced that international tax policy is the preferred instrument for affecting income redistribution. I like income redistribution. I think it's interesting. I think, but in what
I'll
world?
answer it. Do you want Ed to go first?
But Ed,
Well, I have the easier of the 2 questions, because I don't have any interest in justice. Like Jim, I only care about efficiency. I just get there in a more practical vein. So
your concussion is wearing off.
The short of it is that inversions I don't want to speak to Pfizer specifically. They have a ton of permanently reinvested earnings. But the answer is it was access to the stash. I'm not talking Pfizer specifically, but access to the offshore cash and the creation of a brand new ability to opt in through self-help to lower domestic U.S. effective tax rates by virtue of loading up what will then be the U.S. subsidiary with interest expense that has no significance from the point of view of public investors, but that just reduces the U.S. tax bill. So, those are the principal drivers.
Can I just ask a quick question of the panel? Is there anybody up here who doesn't think that we need to tighten our rules about earnings stripping, with certainly with interest, and in some sense, you mentioned royalties, but at least in some sense with intellectual property? I would describe it more broadly.
Right.
Seems to me that you think we should not.
Should not.
Well, now that's an interesting response.
He's written a paper. He wrote a paper
You
about
asked,
it.
I answered.
Why?
He has a good paper about it. It's
Well,
just
I know that paper.
wrong.
I know that paper. That paper is a friend of mine. It's not a good paper.
Are you finished? Are you finished with the first question? Okay, so, Michael, shall I take Mihir's question?
Yes, you take me here as
Look,
question. Sorry.
The
I
connection
knew
with
this was going to get unruly. It's just a question of when.
the connection with economic justice. The first question Mihir asked is it your preferred instrument? And my response to that is motivated by how difficult it is to address inequality. And again, the motivation to me shouldn't be to address inequality in the sense of you're taking something from somebody and giving it to somebody else. It is what is the best socially productive and fairest system that will help the country be best off. And so David Kamen had this nice piece in Tax Law Review that pointed out that if we took all of the income tax and imposing on the top 20% of the U.S. top quintile of income owners, we still would not move the Gini coefficient very much. So you could say, oh, well, then why use tax at all? It's hopeless. The fact is, this is such a difficult issue that you can't ignore and avoid any single piece. It's not a question. I know the economists like to say, choose the best instrument, optimal outcomes, and we know what we're doing. My observation from having been in government in practice is we really don't know what we're doing in large measure, that when government tries to make these fine distinctions between foreign income and U.S. income, we get it wrong just or more often than we get it right. The broader the base, the better off we are. Foreign income, there's really no real excuse to privilege foreign income unless we can justify it with the headquarters argument or with some other reasonably developed database, evidence-based support for it. And I have so far not been overwhelmed with the support, partly because, like Ed, I haven't seen the evidence that we're so disadvantaged among our corporate world that we need to give that group a break and then tax everybody else more in order to fund, I think, our very beneficial spending, which is beneficial because it finances Medicare, it finances all kinds of good social spending, and as well as defense. And as Jim points out, we need the revenue. So I'm very loath to give away revenue.
Michael wants to also say a word.
Can I just come in, picking up on his question, because I think it goes to the heart of what Steve's saying about the nature of the tax, which is, this is, I think as Steve's saying, it is a proxy for personal income tax. We want to have a fair system of income tax for US residents. The question is, does that work? Does corporation tax actually fulfill that goal? And it seems to me that it doesn't at the moment. I mean, it may, if we change the system perhaps, but one thing that you mentioned yourself is foreign portfolio investment. If US individuals want to buy British companies, then they're not taxed under corporation tax. And if UK decides not to have a corporation tax, then they won't be taxed at all. So US income tax, I mean, I'm not an expert on US income tax, but certainly in the UK, and I believe in the US, there's all kinds of forms of investment income which are not taxed.
So we've got time for one more question, and Mr. Berman would like to get in, and since he owns the Tax Policy Center, we ought to let him in.
I'm just thinking about all my untaxed capital gains. So suppose we were convinced that we wanted to have a well-designed territorial system. Concern is that whenever you have a source of income that's exempt, it's really hard to police that boundary. And we kind of imply that, well, we have these boundary problems now, but we could just make them go away by ignoring the foreign income. I'd like you to just comment on that.
I think it's a Jim, right?
I'll start. Is there an issue about policing the boundary of foreign versus domestic? Of course there is. There is now too. But Len's point, and it's right, is that would become even more important if you had a territorial system. That's absolutely right. There is concern. You're not the first to voice concern about that problem, and there's a lot of concern in the United States about if we had a territorial system, then American firms would take profits that were really earned in the United States and somehow attribute them to foreign jurisdictions, and that even though we're concerned about that currently, it'd be more of a concern under a territorial system. The United States is not unique, but close to unique in having the system that we have. The other OECD countries, they've already encountered this problem. Canada has had a territorial system roughly since 1975. Canada still collects loads of corporate tax revenue. And the UK is collecting corporate tax revenue, and Japan and Germany and France and a lot of other countries have encountered the exact same set of issues. Now, does it work perfectly in Canada? Of course not. No tax system is perfectly enforced for the same reason that no laws are 100% complied with. On the other hand, is it a workable system? Absolutely. If it weren't workable, Canada sometime in the last 40 years would have changed their system. And so I think that, yes, we should be concerned about compliance. Yes, if we have a reform, we need to think hard about how it's going to work in practice. Do we have enough resources for the IRS and so on? Of course, we have to think about all of that. But the hysteria that Len was not voicing, but others have about this, I think is misplaced given the international experience that we've got.
Can I speak for the voice of hysteria?
You always do.
By all means.
So, I think that Len's point goes to the insolubility of territorial tax systems. That's why Dave Camp's proposal contained anti-abuse rules. That's why any territorial system that will come out will have anti-abuse rules. We see today in the OECD BEPS project, and the urgency with which the entire OECD is approaching this issue, that all countries have become fed up with what they see as the generation of unconscionable amounts of stateless income by multinational firms headquartered in every developed country. And the question is not, does Canada collect corporate income tax? The question is, does Canada collect the corporate income tax that Canada thinks it should collect on the non-Canadian income of Canadian firms? And that's the relevant question if we're responding to Len, who said, can we design a well-designed territorial system? I would love to have a well-designed territorial system. It would be the simplest thing to do. But I believe that we are confronted by a Hobson's choice. There's nothing, and that as a practical matter, a low-tax corporate tax system of the United States with worldwide tax consolidation so that our rate is squarely in the middle of the other herd of gazelles is a system that removes stateless income gaming and enables U.S. domestic industry to enjoy a more appropriate burden on its capital income.
We are being told firmly.
And so, in conclusion,
that it is time. It is time for us to leave. I'm glad that Senator Hatch was not here for this discussion, because I think if he wanted to walk away with clear guidance on international tax policy, he would have been disappointed. But for the young people in the room who want to continue having this discussion over the next generation, you can leave with great optimism from this panel. Thank you.
Okay, just stay your thing.